Good afternoon, everybody. My name is Brett Augustine, a recovery business advisor for North Central Texas Small Business Development Centers, a leading provider for assistance for small businesses. We are grant funded, which allows us to offer services at no cost. And today we'll be continuing our series with Rebecca Schultz and Liz Laura Carreño. We're going to be talking financial negotiations for business owners, part 2. And for those of you who don't know Rebecca, she's been helping business owners to access money and financial education for over 25 years. She's the founder and executive loan consultant for Centerlock Funding. And also accompanying her today, Liz Lara Carreño is one of Goldman Sachs 10K Small Business National Facility and Subject Matter Experts. Whew, that was a lot, but she's a lot too, and she has a great bit of experience to bring to us today. As well as a business owner herself, she also serves as a director for outreach and marketing for the GS 10K program in Houston. And with that, I would like to leave that to Miss Rebecca Schultz and Liz Laura Carreño.
Thank you, Brett. All right, let's get the presentation going. Give me just one moment, team. And you know what, Liz, we should probably let you also share because there was probably a lot more that could be considered on that intro. So in just a minute, I'll go ahead and ask Liz to share a little bit about her experience. She actually has phenomenal experience to bring to this particular conversation today, but we are talking about financial negotiations, right? This is a continuation. In the first part, we talked a lot about soft skills, bringing in certain beliefs and understandings into negotiation. And today we're getting to the nitty gritty. We're going to talk a little bit more about strategy, areas to negotiate, right? And then really mining those networks and finding the right people to negotiate with. My name is Rebecca Schultz, and I do have Miss Liz Laura Carreño with me. Liz, did you want to go ahead and talk a little bit about yourself?
Sure. This is the part where I usually will put a snapshot up that says blah blah blah, and then we move on to the really good stuff. Um, I'm Liz Lara Carreño, and I am currently the outreach director for the Goldman Sachs 10,000 Small Business Program. It is a national program that was created to support businesses that are in growth mode, and our target audience has been businesses that are in the 2 years and up, 150,000 and up, 4 employees. That includes owner and co-owner, and up. And so in a class of 35, you could have a business owner with co-owners with 2 employees at 150,000 sitting next to somebody who has a $10 million business or a $5 million business in over 50 industries. And the beauty of that is that everybody comes in with their successes and their challenges. Some of them don't know what the challenges are until they actually hear them in the classroom. But the really great thing is the problem solving, the sharing of information. This worked, this doesn't work. This is a new approach, didn't think about that. And I think that anytime you can create an environment for business owners to relax and open up and know that they are not by themselves. They're not alone in their office or alone at home trying to figure out how to make payroll, how to find new revenue streams, how to address operations. And really what we're talking about today is how to talk about money. And that's really what the program focuses on, is the operation. Everybody's great at what they do, but businesses close because of the financial, not having the right target market, and looking at a more effective and efficient operations. And so all of this kind of goes hand in hand. The great thing about the negotiations, and we've probably have worked with, I want to say, a little over 1,000 businesses locally and nationally. And I think Rebecca would agree with me, is that anytime you get a business owner to come to you and said, look, I'm about to get into trouble versus I'm in trouble. We want to know before a decision is made for them. And so for us, it's creating that language, that comfort level, and saying that they can talk about what those issues and challenges are. And we kind of laugh about this because, you know, when I talk about Rebecca, she's kind of like that angelic, calming voice that I'm going to take you to heaven because there's a solution here. And I kind of come in and being the oldest of eight, my nickname was Sarge. I'm going to come in and I'm going to figure out why you got here so that we can make sure that we can put in steps and processes that you don't get here again. So I might give you a spanking, but we're going to make sure that as I hug you all the way through, it's not going to happen again. And it will make you it will make you a stronger and better leader and a more sustainable business. So that's really our focus whenever we have these conversations. And there's nothing that shocks us. And so for us, it's what can we do to support this business owner and take them from business owner to business leader. So that's what today's going to be about.
Yeah, thank you, Liz. I love that. And that is so true, right? Um, so this presentation was made in cooperation with the SBDC. I love partnering with the SBDC because you have great advisors, just like Brett, just like Roger, like Paula, right? And many more that support you and help drive the conversation, connect you to resources. All right, so today's agenda, we've divided up the conversation into 6 points. I'll go ahead and cover the first 3 points, and Liz is going to cover the last 3 points, right? We'll equally divided it. So we're going to talk about the 4 key negotiation points, addressing risk, right? It's like the elephant in the room. We're going to talk a little bit more about Zopa. That was a concept that Liz started to explain in part 1, right? But this is going to be Zopa for the small business loans. We're going to learn about leveraging our assets, leveraging your business network, and then fostering growth. All right, so let's get started. So 4 key negotiation points. All right, so I do this for a living, day in, day out. And it seems really hard, right, in some respects, but really it's not so bad. It's just 4 key points, 4 common conversations that we have and how those blend in, right, and get kind of changed really depends on the conversation that you're having. And we're going to dissect this for you. All right, now note that as we go through the conversation today, in the handouts that are coming along with the presentation, there's going to be a financial negotiation worksheet. All right, so I want you to know we're going to talk about concepts. We're going to give you an idea of range, right? That's the Zopa. But you're going to be able to hopefully take this information into your own personal exercise and really think through the process and get prepared for your next financial negotiation. All right, so common negotiation points, interest rates. That's the number one that most people recognize that they have some control over, or there's some variance or difference they can tap into. We'll explore a little bit more what interest rate really means. That comes in with loan products and the type of funding that you're seeking. And again, we'll give you an idea of ranges momentarily. The second is going to be fees. Now, nobody likes that word, right? Like that is a 4-letter word that starts with an F. Nobody likes it, right? But fees are inevitable for many types of loan products and services, right? But the question is, what kind of fees are normal? Where can you negotiate those fees, right? And then how do you really understand what that conversation is and how much it's costing you, right? And then your power to kind of push back. All right, then we're going to talk about terms. Now, terms, you see me lost for words. Terms are a lot, all right? And there are so many different options within the term conversation, which we'll talk about. But just understand, terms really ties into what you're trying to do, what type of risk you're taking on, right? And they're very flexible. Right. And then we're going to end on loan covenants. So you remember that whole when you're a child, right? You think about covenant, you think about in biblical terms. Well, when you get into a financial relationship, there are really factors that govern your future conversations and relationship. And so we're going to talk about loan covenants. What are they? What do they really entail? What's their purpose? And then really trying to understand when you have the ability to push back, negotiate those loan covenants, right? So those are the 4 key elements that we're going to weave through the conversation today. Let's start a little bit on the interest rates, right? Again, this is the number one key factor. People know that they can negotiate in a financial conversation, but what they may not understand is that it's going to always fluctuate. As I sit here today and we have this conversation, when we wake up tomorrow, there will already be fluctuations happening in the market that are going to impact the interest rates that you might be able to kind of narrow down in a conversation. All right, so I'm going to give you some key elements momentarily so you know what areas, what Zopa, right, that you'll be able to kind of stay in the range with. And that will change, but we'll give you an idea of how to kind of check that market pricing. All right, and then there are set by each lender. What's very interesting to know is that each lender, they are a business themselves. And just like your business, it has its ups and its downs, right? It has its risk and its reward. And so each lender essentially takes a look at their current cash flow, their current pipeline. Right? For loans for them, that's a form of cash flow. It's a service they're providing and they're getting paid on it. They will set those rates, set their interest often. All right, now I can't say it's daily. For some, it's daily. It might be weekly. It might be monthly, quarterly. They will revisit their own financial situation and determine how hungry they are for loans, right? How well they're performing or not performing. And so the rates are going to be set based on an internal environment or climate. So you've got the external market, the internal environment for that bank as a business, right? And just know that even within those contexts, they change that conversation for catering to specific borrowers. And so some borrowers walk into an interest rate negotiation and they immediately know whether they want a fixed rate or a variable rate, right? And sometimes that lender gives you choices, or they drive to one version or the other, right? And that says a lot about what that lender is trying to do to offset risk. But rates can be fixed or variable, and you typically have that option or can drive that conversation. And when we're talking about fixed or variable, you're probably asking, so which one's better, Rebecca? I think I should go with fixed, right? I'm going to pitch it to you this way. It depends on what your overall goals are and the time frame for which you're going to stay connected to the loan or the transaction as to whether or not you want to connect to a fixed rate or a variable rate. Variable rates will tend to be lower, right? And that's essentially the hook. The financial institution is not having to go at risk. If the market prices go up, they can reprice and adjust them with the market, right? But they know that that takes on a little bit of risk for the borrower. So they tend to make those a little bit more attractive. In any given point in time, I'm going to give you an example. They may say your interest rate is 1% over, let's say, Wall Street Journal Prime or some index, right? And they'll say it'll adjust that 1%. And then if you go for fixed rate, they may be starting it at 2% over that same index because they're trying to ascertain what the future will bring. They're uncertain about it too. So they're going to just build in an automatic margin, which makes that interest rate typically higher. And then the very complicated question that comes back to the business owner is whether or not they're going to take the risk on the variable rate, right? What happens with the market, or if they want or feel more comfortable having that fixed or known expense. Right, so it pushes the decision down to you. But when we go in a little more detail about products and where variable and fixed interest rates come in, I'll give you a better understanding of pricing today. Just know that you typically have the negotiation piece of going either fixed or variable in most cases. All right, floors and ceilings. I remember being a junior loan officer and them coming in with this concept, and it blew me away. Very few people know that they have the right to request a floor, meaning the lowest the rate would go, right? And a ceiling, meaning if you're uncomfortable with maybe a variable interest rate going too crazy, too far up, right? You can actually request for them to limit it. In all my years, I've only seen a few sophisticated business owners that really understood that concept. They're able to negotiate and really craft out terms they're very comfortable with, but they limit their exposure to market rate increases by requesting the floors and ceilings conversation, right? You'll typically see lenders or investors do a floor, meaning they don't want the price to go below a certain level, protecting their in-house expenses. But you don't really see them utilize the ceilings, which is more of a conversation for the business owner to request. All right, and then obviously they're connecting variable rates to some type of index or some rate that will go up and down with the market, right? In most cases, it's going to be the Wall Street Journal prime rate for small businesses, but in some cases, they'll talk about the T-bill or the U.S. Treasury notes, whether that's backed for a 5 or 10-year term, right? And so those are typically used by commercial lenders depending on how they've hedged their internal expenses, right? But those are typically going to be the sources of index that you can go back and see what's happened historically with the rise and the fall of those markets to understand or craft how you feel about the fixed or variable rate conversation, right? How comfortable you are with attaching to their specific type of index. All right, now there's another factor here that a lot of people don't think about when they're negotiating interest rates, and that's that the rate can change based off of how they are calculating that interest rate. All right, I know that sounds crazy. So I'm going to give you an example here. All right, if we were looking at a mortgage loan, let's say a consumer mortgage loan, most of those loans are done on a calculation called the Rule of 78, which means that you're going to pay more interest on that loan up front, even ahead of just looking at an average uh, rate based off of an outstanding balance. They will push for you to pay off the loan at the very beginning. And then by the end of that loan, it'll primarily be principal repayment, right? And so the lender controls how they calculate the interest. So it might be 5% interest between two different lenders, but one lender might be using the 365 by 365 for every day of the year. You're being charged interest on the outstanding balance. And the other lender might be doing a rule of 78. And if you were to look at what we call the amortization schedules, that's showing you how much interest and principal is spread over a period of time of that loan, right? You would only be able to figure out, you know, how they were doing the calculations, and one way might be better than the other for you, right? You might want to pay this loan off instead of 5 years, 2 years. And if the lender had the rule of 78, right, you wouldn't really have the full advantage as if you were going with the lender that was calculating interest on the outstanding balance for each day, right? You would have a better advantage paying off early and choosing the 365 by 365. Now, I know that was a lot of information. All right, so I'm going to let you process that for a minute. I'm just going to summarize here. All right, so rates fluctuate. So getting the loan today might be better than getting the loan tomorrow, depending on how the economists or the economy itself is moving, right? You have that pressure that you're trying to understand. Each lender internally have got their own makeup and their own fees and bills and overhead they're trying to cover, right? So rates will change based off of that internal structure. Then we've got to understand that fixed and variable. Where is your risk on that, right? How comfortable are you with that? Are there floors and ceilings you want to consider? Something to throw in there on a variable rate negotiation. And then, of course, understanding the indexes, whether that's Wall Street Journal Prime or T-bills, right? How comfortable are you with that? And then really get into the nitty gritty on how they're calculating the interest, because a rate is not just it. You have to understand how the calculation happens. Whoop. Okay, ready? Next point, fees, right? It's that four-letter word that starts with F. I know. Okay, so just know, take it down. It's okay. Fees are common, All right, they're to be expected. When you borrow money, there's really no way around fees. That's kind of the name of the game, right? There's fees out there. But you can control how much those fees are, right? And then have a basic understanding of why the fees are being put in place, right? That's what people don't really think about. But fees, when they are expressed, right, when they're told to you what those fees are, they're going to tell us what that lender's priority is. Out-of-pocket expenses, let's say you learned that there was going to be a fee for an appraisal, or a fee for maybe a review, or a fee for a credit bureau, right? Or underwriting. All of that is an out-of-pocket expense. The lender doesn't want to take on the expenses, so they're pushing them over to you. You can't control that, right? That's typically how that conversation happens. What you can do is to compare out-of-pocket expenses between lenders, right? And say, you know what, XYZ Bank, right, has a lower application fee or underwriting fee than ABC Bank, right? Like you're comparing two banks and you can compare the fees. Because just like if you were to go to Walmart and you were to price match, I know, you can do that, right? You can say, well, hey, this bank is going to charge me less for that out-of-pocket expense. Would you consider paying less? And most of the time, right, that is an easy conversation to have. They'll price match. All right, then protecting the lender profitability. All right, so when lenders are imposing fees that require that you do not pay them off early, right? There's a prepayment fee. Or that lender wants to make sure that you do not, um, what would you say? There's a fee there for you not transferring or selling that business, right? There's no I'm thinking get out of jail free card, right? There's no assumptions on it, right? They're essentially trying to make sure that you stay locked into that original agreement for a period of time so that they can make their money, right? They want to make sure they're profitable. All right, and then the final conversation with these are essentially ensuring compliance. So they have terms in there that if you do not meet certain conditions within the loan, that they could call the loan due, right? Or they could raise the interest rate, right? That is written into those fine gray lines on the back of that agreement. So if we call it a debt service coverage, but if my business is not profitable enough, right, they could turn around and then raise my interest rate to a higher rate and essentially try to make sure that they're collecting their profitability early out of the loan and then leaving me with an even bigger bill, right, or expense, right? That's ensuring compliance. If I don't meet their requirements, I could be dinged or see another fee. Okay. So fees, they come in different shapes, sizes, different reasons, right? We want to make sure that we try to understand why that lender is giving that fee and then try to look and see whether or not another lender is charging a similar fee, right? That's where we're giving our Zopa, right? Zone of potential.
Zone of possible agreement.
Thank you. Zone of possible agreement, where we're looking at the lows and the highs and trying to come to a middle ground, right? And we're using two financial institutions, typically or more, information to try to understand that, engage it. All right. And then, of course, obviously, if there are issues with profitability, right? Asking for them to discount or waive fees is out there. And then, obviously, compliance fees can be heavily negotiated, right? Compliance means there's a conversation, there's a relationship that's developing, and that could be negotiated based off of you addressing those concerns as opposed to just taking the fee. And so we'll talk more about that in just a minute. All right, so let's talk about terms. All right, terms, there's a lot to it, right? As I speak, I'm just going to say you can actually create more terms. You can craft those. So this is not a end all be all conversation, right? You can get very creative, but terms typically tell the lender or show the lender how you're going to repay back that loan, right? What are the interests? So how quickly do they need their investment back, right? How fast do they want you to pay it back? How confident they are in your ability to repay them or for them to collect their money, right? And then how they want to build that relationship. Do they want a long-term relationship or short-term relationship? Right? So when they give you an idea of what kind of terms they're offering, it really helps you understand where their mindset is within that relationship. All right. Terms are typically going to be connected to internal lender policy. Right. And that gets to be a little difficult because sometimes if you are looking and you want a longer term on that loan, that loan officer, that financial advisor for that firm may come back and say, I can't give you 10 years on this. My policy only says I can do 5 years, right? There's no arguing against internal policy. Every now and then you can get them to make exceptions. So you kind of have to know what that policy is and how much room you can push based off of it. All right. Oftentimes, terms are going to be connected to understanding what collateral. Remember, collateral is a secondary form of repayment. So if the lender, you don't pay back that lender out of cash flow, like the business is operating well, they're looking for another way to get paid back, right? They're going to be looking at that collateral. And a lot of lenders say that collateral value protects or offsets the risk for a period of time. So that useful life is how they frame it, kind of protects it, and they want to make sure that their loan term fits within that actual useful life, right? That term and useful life are connected. All right. In terms comes another conversation, and if you don't know what they're saying, it sounds like they're speaking another language, and that is called amortization, right? They might call it amortization. And so it is saying the life of the loan, like how long they're allowing you to push off that repayment. But what may happen is they'll let you go, let's say 10 years on an amortization. So you take your amount borrowed at that rate over 10 years, but they may force what we call a balloon payment, meaning that they want you to renegotiate the rate or pay it off in full within a shorter term. All right, so that would be expressed as X rate over Y amortization, let's say 10 years, but repaid back in 5-year term. So that rate is only being guaranteed for the 5-year term. They're just letting you make smaller payments because they're letting the payments go a longer term or a longer amortization than the term. I know that's confusing, right? Just be careful because ideally amortizations are used to make things affordable, but it has no bearing on how long your loan payment goes, right? And they may force that loan payment to come due quickly, which makes you have to renegotiate the whole loan or have to pay it all back. You have to be very careful. All right, and so let's talk about loan covenants because remember that's the relationship aspect. All right, and this also tells you what's happening in that lender's mind, right? What are their concerns? These are going to be conditions that is placed on the borrowing relationship even before it's begun, right? They're like basically saying you have to complete certain things, certain tasks, or operate in a certain manner. And that's how we're going to like go on in this relationship together. And people that don't read through the fine lines and make sure that they're good with the terms find themselves either fined, right? There's fees involved, right? Because you're not meeting those loan covenants, or they find themselves quickly in hot water. Okay, so covenant areas, what does that include? Profitability expectations. So in the lending world, and if you've taken any of the financial I would say credit analysis courses with us, right? Then you would understand this. But for every dollar that you are creating or generating out of your business, right, they would want you to not spend in payment obligations 75 cents, right? So they always want to make sure you keep a quarter in your pocket every time. So if you're not being as profitable, right, one year your profitability goes down, that could trigger fees, increased rates, right? Or you'd break the covenant and they would call you into default and try to collect all the money. Right? That's how scary things can get. Okay, other covenants include limiting repayment to other lenders. So they may tell you that you can't go and take on a loan with another lender. Right? That they write that in the fine line. You can only go to them for future loans. And if you haven't fully discovered that relationship and whether or not it can support you, you would have completely limited your company's ability to get growth capital, right? Big difference there, right? It also, they could limit your shareholder payments. So let's say you go into this loan and the business is doing all right and you decide you want to pay yourself a little bit more that year. Be careful. They might put in loan covenants that you can't pay yourself any additional shares, right? They might like lower that amount so that you can only pay yourself a certain threshold, because what they're anticipating is that you pay them back before you can pay yourself, right? They're putting themselves as a priority in the conversation. All right, so documentation covenants also set the tone for future communication. So they may tell you, we want to see your financial statements annually. That's very common, right? They want to make sure you're still performing, the business is still doing well. So they may say, I want your tax returns annually. I maybe want your end of year balance sheet, profit and loss statement. Maybe they want an updated personal financial statement. So how are the business owners doing? Are they getting more into debt? Right? Are they liquidating their personal assets? That all could show signs of risk for them. So that could be on an annual basis, or depending on the type of loan product, they might want to see financial communication more often, monthly, quarterly. That's all part of the negotiation. All right. Also, too, they may want to see whether or not your customers, clients, are paying you on time. That's a big one right now. There's a lot of supply chain interruption. Um, Business owners may not be getting their payments to vendors on time or collecting money from clients or customers on time. And they want to make sure they're monitoring that for specific businesses that are in industries that might be prone to that type of problem. Essentially, they're trying to see if you're going to be able to collect the money, because they want to make sure they collect their money first, right? All right, as well as just collections of revenue in general, right? This is a scary time. International trade is difficult right now. How that funnels down to all businesses, large and small, is still somewhat unknown. And there's increased delinquency that's on the rise, and that's projected to go into 2022. And so I foresee anybody going into future financial negotiations, that is something that could be part of a future loan covenant that you would have to discuss. All right, so remember, the lenders, they can utilize this tool to try to help define monitoring risk, making sure they understand the relationship. You can negotiate out loan covenants, but you really want to make sure you have a good, clear understanding of what that relationship will do for you today and if they'll be able to continue serving you in the future. And Liz will actually talk more about that in just a moment. All right, that was a lot, right? I know. It's not easy. Now I'm going to hopefully tie all this together for you. All right, let's talk about addressing risk. Because just as I had mentioned in the loan covenants, right, lenders are trying to identify and speak to risk. And so how do you address that before you go into the negotiation conversation? So what are those areas of risk you need to be wary of, right? So small business lenders look for risk in the following areas. I want you to define this for yourself. There's going to be industry risk, right? If you were a hotel in 2020, you'd have had a lot of industry risk, right? People were not traveling. They didn't feel comfortable traveling. And so that was a risk that came out of the blue, right? So think about your industry. What are the risks for your industry? Credit, okay? Other borrowing relationships. What if you have a loan covenant and another borrowing relationship that doesn't allow for you to make additional loans, right? Like that's a real thing. So maybe having other creditors involved that have different expectations, right? Or let's say that other creditor wants to be paid first, and so they're holding on to maybe a lien, right? That's a legal term where they've got collateral against you and they won't let you go, right? Think about that. So other creditors can come into that conversation. All right. Accounts receivable repayment. So what if your customers or clients aren't paying you on time? Your terms on your repayment are 30 days and they're taking 45 days to pay you, right? That looks like an area of risk for a future lender. This is a good one. Employee misconduct. Okay. Yeah, you don't want to ever run into a situation, but what if you have employees that aren't trained well, right? Or you have hired incorrectly, or maybe not even done background checks and it's required of your industry, right? And then you create a liability because of that employee, right? That's something that is of risk, and how do you protect yourself from it? Labor shortages, right? That is huge right now in the current environment. How are you protecting your business from labor shortages? How are you addressing that issue, especially if your industry's been hit hard by that, right? Are there any legal ramifications? Immediately, I'm thinking of no compete clauses, right? So what if your key employee takes off, right? Takes your customers and you end up in a legal battle with them. Or let's say a competitor says you stepped on some type of, you know, copyright, infringement, and they start suing you. How do you navigate that? That's an area of risk that needs to be considered. Supply chain issues. Right? Some businesses don't have a lot of option. They're having to wait for supplies to come from overseas before they can sell or produce the product. They're stuck, right? Marketing, right? Are you marketing? That's the better question. And are you marketing enough? Are you marketing to the right target audiences? That can become an area of risk. And then, of course, especially if you're getting an SBA loan, they want to know, how are you mitigating the owner risk, right? What if you die? What if you burn out and don't want to do it anymore, right? What if you have a divorce and that partner wants a portion of the business or needs to be bought out of the business and takes a large chunk of it, right? What if there's partners and you guys have a dispute? How do you resolve that? These are areas of the risk that the small business owner needs to consider, because they are going to be areas of the risk that the lender are going to be looking at, just gleaning in to see whether or not you are protecting yourself, you're addressing it before it becomes a problem in a future financial conversation or contract. I know, right? Ew. All right, so how do you address it, right? So number one, first step, right? It's always acknowledging the risk exists. So you don't walk into that financial negotiation with your fingers in your ear, la, 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 la. And the lender's trying to ask you questions, really trying to gauge whether or not you're savvy enough to protect the business on any of these risks. And you gloss over it, right? You don't even act like it exists. You're like, who are they? They have no idea what they're talking about. Don't act like that, okay? Just make sure you acknowledge their concerns if there is a risk, or talk through it, right? Maybe you might learn something. Maybe there is no risk and they just needed to hear you say that or show them in some way that that was not going to impact your operations, right? Hopefully you've connected with a good insurance professional, right? They are worth their weight in gold. And those insurance professionals can look at your industry, look at how you're doing business, and help you craft protection around that, right? Fantastic way of sharing with an investor that you're managing risk. All right. How about internal policies, procedures? So maybe you've got cash in your business, and that cash is a big part of that investor getting repaid. And you're customers, let's say your employees are managing that cash or out in the open, right? You would want to have specific internal policies and procedures on how you manage that cash, how you protect that company, your closing and opening day situation, right? So what kind of policies and procedures are in place that protect you from having complications with employee losses, right? Or cash flow losses? Think through that. And then selecting the staff to manage specific roles and responsibilities. And this is probably, I don't know, this is up there within the top risk for a small business. And that is the fact the business owner tends to take on too many roles, right? And if something happens to them, or let's say they're too focused on one area of the business, that they won't see a problem or a risk coming up that essentially causes a large loss. All right. So being able to speak to having different roles or having responsibilities delegated is a big factor for a lot of investors. And they want to see that you have set up that structure. Now, how you answer that question typically comes in with a business plan, a business history. You're identifying key responsibilities or people within the business, right? Resumes to show you've addressed those risks out there for loading too many responsibilities on one person and having that person be compromised. Okay, the other aspect is updating your bookkeeping, right? Your QuickBooks. You want to make sure that you are keeping up with the financial performance of your business and that you can see problems arising before they hit you, right? And so how quickly you update your finances is a big part of a financial negotiation conversation. If you are not able to provide them with the last quarter's financials, because maybe you only do your financials once a year, right? That is speaking loudly to potential risk. So keeping updated bookkeeping is a big part of that. Right, and then investing in your staff with training and development, right? So that they are always being supported with areas of concern, areas of improvement. That is a way that you can show you take that responsibility. Um, you take on that responsibility and you're helping those individuals understand and mitigate those risks internally. And then strong reporting and leadership skills, right? So if you can provide that reporting quickly to those investors, right, and you're getting those reports and you're looking at them, right, and you're able to take that information and lead from it, that is a big part of you seeing and leading to potential risk and not getting bogged down and getting hurt, right? And I like to say, be curious. Addressing risk means there's a certain part of you always questioning and wanting to make sure you're doing things in a manner that protects you. And by keeping that curiosity and going into any lender conversations with curiosity as to why they think that that's a risk, it leads you in an open conversation that might help you see things that you're not already seeing or addressing. All right, so mitigating risk. So how do you mitigate risk? All right, so what you have to do is make sure you know what you have in control, right? How do you control this? Um, First question to ask yourself is what keeps you up at night? How do you monitor your own known risks, right? If you can share with an investor or a lender what you know your risks are, what keeps you up at night, and how you're protecting yourself from that, you're going to do far better in that conversation because they're going to have a little bit understanding of who you are as a business owner, right? Share your experience and your realities. Again, confidence that you know what you're talking about, you have the expertise, you can see the risk as it's coming and navigate around it, right? It helps you build confidence. It helps you understand that you're bridging that communication and relationship and it allows you to be open, right? It allows you to be open to lender concerns, and that might actually help you in a financial negotiation. It drives open conversation. All right, so competition risk. Lenders look at this as being a big question, right? Because competition's all around us. Who are your competitors? Do you even know who they are, right? And what's your competitive advantage? If you can't answer a very basic, almost just check mark box conversation on risk, right? They oftentimes don't feel comfortable that you are strong enough in business to really get far in that negotiation conversation. So be careful. Your response is going to be critical to mitigating risk in the future, right? And there is innovation all around us from outside companies. The compensation, the competition risk factor is always out there, right? Hopefully you're seeking customer feedback. That's a big part of understanding this risk, and you know what competitor provides that critical point of view, right? So knowing that competitor, knowing what makes you different is really important as you're going into financial negotiation conversations. Okay, so these are some hot topics. So supply chain interruptions, be prepared to answer that question from potential financial negotiation partners, right? Lenders, investors. Environmental climate change, that is a hot one. There's a lot of money going out there for companies that are doing things in a green way, right? Or they're driving to green consciousness. Last thing you want to do is go in and say, you have no idea what they're talking about, yet you own a dry cleaning business that has been in the same location for 30 years, and you don't have any internal policies on how you're protecting environmental change, right? Number one, the government is all over that, right? And you are having to speak to environmental issues and making sure that you're not contributing to any negative climate change. So understand that is a real thing in the lending world, right? Sourcing. So how are you sourcing your products or goods? Right? Inflation. That's one that is all over the news right now. We know inflation is hitting. It's happening right now. We know that's going to continue into 2022. Right? So is your business able to renegotiate contracts and terms, right? Reprice as inflation becomes an issue, and how big of an issue is that going to be for your business? And then supplier vendor relationships, right? So what do those look like? Are they going to be stuck in an inflation situation or a supply chain issue, right? Are you going to be able to get paid from the supplier and vendors? And then this is a good one, right? Do you have a disaster plan? That is a question that every business right now that's getting lending has to answer to. If they don't have a disaster plan, that's a problem, right? They want to see what you've done during COVID, the pandemic, right? And then how you're going to be able to guide and lead the business if another wave comes, or we have a hurricane or other natural disaster that's related to your area. So hot topics, be prepared to answer that as a form of risk. Okay, so Zopa, and Liz talked about this in part one. I'm just going to follow up and talk about how Zopa, when we're talking about interest rates, like those four key critical areas of negotiation, how that all flows together with what we've talked about, right? First, understand for you to really define your Zopa, your loan products are going to be defined by purpose, right? So first question to answer is, why are you going to them for a loan? Why are you entering into the financial negotiation? Are you trying to buy equipment? Are you replacing equipment? Do you need working capital? Like, are your operation expenses increasing because you're hiring more people, or maybe you need to do more marketing, or you're not able to collect your money on time, accounts receivables? Are you purchasing commercial real estate? Right? Are you purchasing inventory because there's a high demand or new inventory needs? Right? Are you buying a business? Are you acquiring it? Is there a refinance or consolidation? Right? Your loan purpose is going to shape the loan product and the loan terms. Remember, terms were those collateral conversations on how they framed risk, right? So how you're going to use the money and what type of collateral all comes together in this negotiation conversation. So just remember, there is a loan product for every purpose. All right, so how you're going to use those funds are going to be key for how they're going to want to monitor your business risk. If I am getting money to spend in marketing, right, they're going to be very interested to know if it's working, right? Did I take the money, invest it in marketing, and then are my sales increasing? So the monitoring going forward are going to be my revenue increases, right? It's all connected. Okay, loan products are set up to support the use of funds, and that restructure, those four key areas are going to be placed around that use of funds in that loan product. So think of the lender as like the doctor, right? You come into them with a problem or a need, right? They're going to be prescribing medication, they're going to be prescribing a loan product, and they're going to want to look and see, like test results, if it's working, right? And that's how they monitor the desired outcomes. Are they really helping you? So common loan products are going to be things like the SBA loans, that's the SBA 7A, SBA Express, the 7A Community Advantage, right, and the 504 loan. They're going to talk about permanent working capital. We call them term loans. It's pretty much term loan. Lines of credit, credit cards, merchant advance loans, asset-based loans or ABL, purchase order financing, factoring, venture capital, angel investing, and equity partners. All right, so these are common loan products. You'll hear these called out. Remember, each of these are used for different purposes. Think of them as like, you know, problems or ailments that the lender doctor is going to come and prescribe this product for. All right, and then that Zopa, that is going to be based off of your loan type. All right, so your Zopa exists. For each loan type, you're using your 4 common negotiation points to understand your Zopa, right? Your interest rate, your fees, your terms, your loan covenants that we talked about. You gather marketing data from the different lenders, right? And you're going to understand that they're looking at those loan products. And then you're going to basically compare this information. You're going to do your work on your negotiation worksheet. Now, I've put all this information into that worksheet so you can start to connect it based off of your needs to determine your desired outcome, So I wanted to go back over what was the Zopa for the different products, right? Remember, this is all based off of the current market and the ranges. So I'm going to give you just a quick understanding of what to anticipate. For SBA loans, for 7A loan, typically it's going to be based off of the Wall Street Journal Prime. It's going to be a variable rate loan. Very few SBA lenders will do fixed rate right now, as they're anticipating market changes coming up into 2022. So if you can get a fixed rate, that's fantastic. I would imagine fixed rates would be around 6.5%. Okay, that's pretty high. If you're going for variable, you can go anywhere from 1% over Wall Street Journal Prime, which is at 3.25, so 4.25 being the current rate, and it can go typically up to 2.5% for a 7A. But if you're going through the Community Advantage program, it's a smaller loan program, then they can go up as high as 6% over Wall Street Journal Prime, right? So you'd be looking at something in the 9, just under 10% range. Wow, right? 504 loans are for construction or real estate purchase. They're connected to real estate or heavy equipment, and it's 2 loans in one, but the average rate between the 2 loans is going to be right around 3%, right? Really nice and low, but that would be part of the loan under a fixed interest rate, right? And then the other part under a variable rate. So remember your terms and amortization schedules. All right. And then permanent working capital loans, typically 5 years. That's the max that they'll go. Some may want it to be less than 5 years based on your cash flow or how quickly you'll have that loan paid off. Right? Lines of credit, they typically are going to renew every year, right? And they're going to be a percentage of what your cash flow is or what your future cash flow is. So they're going to be looking at accounts receivable. Credit card interest rates could be as low as 7%. Right? I know, right? 7% on a variable rate, and they could be as high as 25%. There's a big range there, right? And then merchant advance loans, those are typically be pretty expensive. I've seen them as low as 8%, but I've seen them as high as 40%. That's right, I didn't misspeak there, 40%. You have to be careful with those loans. Their repayment schedules are very quick. They typically want to be paid off in 2, 3. I don't see anybody going over 5 years, but it would be rare to get a 5-year term on those. Asset-based loans are going to be based on the life expectancy of the asset. Okay, so that's a big one there. They may let you go on heavy equipment as long as 7 years, but typically they want to be paid off quickly. And then purchase order financing is just off of you buying the inventory to sell. So typically when you collect your money, they're repaying it. And that's going to be anywhere from 1 to 3% of your anticipated profit, right? And then factoring is very similar. They're going to want 1 to 3% off of the amount you're collecting. And that 1 to 3% is negotiable. All right, here we go. So negotiating tips, know your limits, prepare for the best. All right, so know your limits. What's your risk threshold? All right, what do you want? What do you will not accept? All right, prepare for the best by understanding the negotiation pieces. All right, determine your anchor. So Liz will talk about this, and I'm sure she's already talked about it, but you go in with an anchor that if you're trying to buy, it's typically lower, right? If you're trying to sell, it's typically higher. So you're pulling your Zopa into a area or that zone of Liz, zone of, she's laughing at me. This is Liz's area of
Zone of
expertise.
possible agreement.
There you go.
Yes.
Thank you. All right. And then
I'm,
understand
I'm
the
paying
lender's
attention.
needs. Thank you, Brett. Understand the lender's needs and goals, right? You've hopefully discovered that as you are seeing them quote fees, as you're seeing them structure the loan, you'll kind of see what's their consideration, right? But understand their needs, even talk with them about that, right? And then you'll go over the non-financial aspects to negotiation. You hopefully define what success looks like in your negotiating worksheet, right? What makes you understand you're successful? How do you feel? You'll do some reflection off of the negotiation process, and then you can see all of that connected for your own use in the negotiation worksheet, which is being included as an attachment. All right, team. And so with that, this is where I get to turn it over to Liz and let her take over.
Hi, everyone. We're going to take some of the aspects that Rebecca's already shared, and we're going to incorporate them when it comes into the actual communication. Rebecca, do you want me to go ahead and show mine now? Is that it?
Yes,
Let's
ma'am.
see.
Thank you.
Is that mine now?
Yes, ma'am.
Okay. I think mine is in that PDF format. Does that
Yeah,
work there?
it works.
It works? Okay. There we go. So when we talk about leveraging your assets, a lot of times when business owners begin to communicate and they are at their financial institution thinking, I hope I get this loan, and it begins that conversation. It's all revolves around, the money aspect. Um, One of the exercises that I put a number of our business owners through is to really begin to make a list. Rebecca talked about sharing a document. What are the top 10 things that you should have that should always be up to date, and that is reviewing all of your numbers, reviewing your assets. But it is also making a list of everything that you have internally and externally, and recognizing that. What is it that's non-monetary there at the table that you can actually bring into conversation? And you can almost look at this as being an interview type, meaning that I've gotten all of your documentation, just like if you were applying for a job. I've got your resume. I've got all of the backup information that I need. So I've read through everything. And the purpose of having that face-to-face negotiation at this point is you're looking for a desired outcome, as are they. And this could be that you are looking for an interest rate that is much lower than what they may have originally offered. You are looking to negotiate the terms that they may be considering based on the money that you're asking, based on what your credit is. So you really have to be prepared and knowing what you have and what they have. And at this point, the only thing that could really begin to change that conversation is how you come in and communicate. It's also about behaviors, more so behaviors than it is personality. And when I talk about behaviors, it's that ability to listen to what is being said and open to that conversation. Be strong from the inside out. So know the numbers and know the value proposition that your company brings in the industry, in the community. When you are dealing with the different financial institutions, I mean, they really are now in communities. Those financial institutions were circled around the Woodlands, around Sugarland, around the East End, and so they have a strong presence there, and you need to determine, do you have that strong brand as well, and is recognizable? And if so, then what is attached to that? So when I say be strong from the outside in, know the power of your brand in that ecosystem. So you begin to create that list of what those, let me move up to the next slide here. To what that list contains is that a list of all the clients that you service, maybe in that community. Maybe you're now beginning to service a new community that would be considered prime candidates for that particular financial institutions. Let's take a look at your financial accounts. What accounts can I actually bring to this financial institution that I'm asking for this loan and I'm negotiating, that new process? You might have more than one checking, saving, CDs. So really begin to create that list, which is what I meant by know yourself from the inside out. So making a list of those. Your network of industry associations. How many boards do you sit on? How many of those organizations do you actually engage with that could be a potential client for this financial institutions that allow you to make those introductions? So again, understanding what your strengths are and what you bring to the table, you're able to communicate with confidence of what your role is, not only in that community but in that industry as well as web and marketing presence. The opportunity to share that you're working with this financial institution, and they've allowed you to, they as a partner have been able to support you in your growth. And so when you're talking about your brand from the inside out, you really need to come in and be prepared with what those numbers look like, telling your story. That once again, going back to that value proposition and the importance of that. Now, this isn't begging. This is about, and this isn't about convincing. It's really about educate them more so than what they have there on paper. And that's really what you should take that 30 minutes to 1 hour, and having that conversation that you weren't able to actually share there. But now we're talking about it. So communicating with confidence and not leaving anything on the table. When I look at any kind of a contract, or I don't care if it's something with AT&T, or I'm negotiating with a chamber or something to sponsor an event, I go through everything and I look at, can I negotiate this and what do I have? So I look for my BATNA, which is the best alternative to a negotiated agreement. What are the 2 or the 3 things that could shift the percentage of this? So you want to go after it. I mean, what's the worst that somebody can say? No. But you'd be surprised at the number of people that don't even take that step. So it's really important that you take a day and begin to write all those monetary streams that you are not really thinking of, that are tied to that financial application. Does anybody have any questions around that piece there? Okay, the next piece is about leveraging some of your business networks and the power of relationships and action. I cannot even begin to tell you the importance of this. When people are looking for investors, whether they are the startups or those that are in growth mode, especially right now. Right now, there is not a shortage of organizations and banks, major primes that are putting on uh, different kinds of fundings. And all it takes is, it's very easy. They give you all of the requirements that you need to apply. And it doesn't cost you anything for those applications. It takes time to do that. I actually have a number of business owners that will take one day out of each week and we'll go through everything. Uh, I'm going to give you an example. I was at NABL, National Association of Women Business Owners, and one of the women there who just opened up a store. She was doing things online and it's done exceedingly well, but she's also decided in her community to open up brick and mortar and was looking for investors to be able to do this outside the financial institution. And so she literally took one day and began to go through every cosmetic, every handbag, every major label to look for anyone that was promoting any kind of funding or free money for application or grants that for business owners that were in growth mode or startups. So for those that are hungry enough, they will do that. Most investors, the typical usually start with their family and their friends. Crowdfunding has really become uh, a really big source now. Industry expos. I've met a number of those folks at industry expos that are looking for that next big thing. And there's a number of businesses, I will tell you, even within the Goldman Sachs, some of the classes, the cohorts within themselves have decided to get together and have pooled their funds to literally fund or provide some kind of grants to small businesses as angel investors because they now want to expand their portfolio as investors. So there, some of them do it, very small with 5,000, and some have gone up to as much as 50,000 on some of my national cohorts. Affiliate organizations, probably more so than now. And what I mean by affiliate organizations is that Greater Houston Black Chamber, Houston Area Urban League, you've got the the U.S. Hispanic Chamber with Verizon or an Amagi or PNR. Those particular organizations are now looking at funding businesses depending on your ethnicity, minorities, and for women business owned. LGBT also has their own funding sources. So there's a lot of those affiliate organizations that are promoting that. But it's going to, again, how hungry are you to begin to look at that? And I think I've already talked about the angel investors, but there's also PitchBook and EquityNet. There's a number of organizations that actually have a list of those investors that you can go and look for, and many of them are divided by industries. So you can look at IT, you can look at AI or manufacturing, and you also have those. Some of them do have a price to get access to that, but I think it's minimal depending on the kind of funding that you're looking for. So it's really easy to engage and find some of those. Let me see here. In my next slide, one of the things that I always have tell my business owners, as part of an exit strategy, is that it doesn't matter whether you're a startup or if you're in growth mode. Um, there must always be an exit strategy. And within that folder, it has your business plan. It has, your growth strategy. It has your updated numbers of your profit and loss sheet, list of everything of your capital investments that you have there. But it should also include a pitch deck, whether you're raising money, converting new clients, or showcasing your company. So it's always ready to go. and you could have it in 2 or 3 formats based on the audience that you're going to be presenting. And in a pitch deck, not that you're going to be taking a physical pitch deck to meet with your financial institution, unless, of course, it's something that they're open to. But it really is a kind of a walkthrough exercise of identifying the idea and the opportunity and the problem that exists. And this is how this came about with my company. And when we saw 25% increase based on this problem that was happening in the industry, we began to focus on who could be that target market and really create a strategy to address that need, and begin to look to our internals and build that team and come up with those solutions. And with that, we're asking for the following capital in order to launch this particular product and service. So you've got that exercise that it's taking you through that, and you're prepared versus, okay, I'm looking for an answer here. You want to come in there and say, I know my company, here's what we're going to create. Here's what it's going to do. Here's our target audience that we've already identified, and we've got the stats to back that up. And here's the capital that we will need to do that. And so when you're asking for that and you're beginning to go through that process of negotiating, the interest, and all the terms, I always tell our business owners, if you're in front of the bank where you've kept your checking account for 10 years, and you're thinking, I hope I get this loan. Hope is not a plan here. You should already know, because you should already know your financial institution, just like you're probably under the assumption that they know your business. So it really works both ways, but at the end, what is the end result that I am looking for? So a couple of things that, to keep in mind as you're going through this process is, in your financial institution, let me get back here, is continuing to, foster those financial connections with those institutions out there. Now, when we were doing face-to-face, I was probably doing 2 to 3 events a day, 5 days a week, as well as some evening events. And financial institutions are always present there. Just like you're there to look for business, they're there to look for business. And just because you've just closed a deal with one financial institution, maybe you agreed on the terms and the interest, and it worked really well for this particular project, doesn't necessarily mean that it's going to be the right financial institution for the next project. So you're not married to them at this point. This is about, let's go out and let's see what else is out there. So I really encourage our business owners to go out and talk with the other financial institutions, and let them know what some of your ideas are. And if they invite you in to have this conversation, then there's no harm in having that conversation. You want to be able to explore, 2 to 5 institutions to determine what's going to be the best fit for my next project. And that should always be, your next step. So don't be satisfied with just one. It's important for you to continue that process, because as Rebecca pointed out, terms and conditions are going to change. They have their goals just like you have your goals at this point. And let's say that you've got a product or a service that is going to benefit a different community, maybe a community that isn't currently being serviced by the financial institution that you're in right now. So, this is one way. Again, I'm coming in here with a number of clients or vendors. I'm coming in with a brand, and the opportunity to work with a different financial institution that could elevate my next product and my growth strategy, would benefit both organizations. So it is really raising that comfort level within yourself, that confidence to have that talk about money. I usually recommend there we go. I usually recommend two books to our business owners who are not comfortable having conversations about money and having conversations, when it comes to HR and people's. One is Crucial Conversations, and the second is Crucial Confrontations. And the crucial conversations are those tough conversations, where you really have to have that candid, sometimes it's being candid with yourself about your money situation, and where you want to go. But you need to understand that this is about growth and not to make it personal. It is about business. And I need to build a relationship of someone that is going to help shepherd this to the next level. Crucial confrontations are when trust is lost. So it's important that you create a good business relationship with that banker so that you understand the terms and conditions and you adhere to them. Because the last thing we want is any kind of default, and trust is lost. And once you lose it, whether it's with an internal or an external client, it's very hard to gain that back. So again, see the opportunities to engage and build relationships with other financial institutions. Bank and their representatives, they change. I know business owners who follow the banker and not the bank, because they know their industry. Some folks who follow the bank and not the banker, because of their presence or how they've been able to support the growth of their business in that particular industry. So it's always good to visit with everyone and have that conversation. And not that you're playing one off the other, but it is about business, and as I said, what are the end results that you're looking for within your business. So I know that there's been a lot of talking here, and what I'm going to do is I think that's it for me on the slides. So are there any questions at this point?
If anybody does have any questions, please don't hesitate to drop them in. Thank you for that. And we're going to go ahead and get with them as we go. First of all, thank you, Liz, so much. And let's get to some of these questions that are coming up. How do you determine how to leverage board memberships or industry recognition can be used?
So when you talk about board memberships, that is about relationships. You also want to, anytime you sit on a board or I sit on a board, I immediately look at who is part of that board and who I need to start building my relationships, not only for potential businesses, but who they do their financial business with, if it's not a financial institution. If it's a financial institution, I let them know what my business is, what my industry is in, and then that conversation begins. So when I leverage that is that I want them to know what my brand and my presence is in that ecosystem. So you need to really, the one thing that our business owners don't do is they don't leverage their ecosystems enough, or they don't understand it enough to leverage it when they go in and that have that conversation. So this isn't a quick pro quo type of thing. This isn't doing anything illegal. It's that I happen to have a manufacturing company of computers, and I am a supplier for Microsoft currently, or HP Dell, and I provide them with the following as part of their supply chain. And so that conversation begins, and we've got an opportunity to expand and open up another in the Woodlands area. I'm in the current East End, and here's our opportunity. So you want to begin to leverage that and let them know that it's about growth and it's about business. So they're going to come back, they're going to look you up, they're going to, determine just what your strengths are. But beginning that one-on-one relationship, and Brett, it was really great to meet you. Here's a link to my company. Hopefully we can have some coffee, or I'd like to invite you out and let you take a look at our facility, for some future business. So I definitely, more business is done when you've got that opportunity, not just businesses, but, even employees when they get that opportunity to network. So it's that here's what I bring to the table. I bring almost 1,000 businesses in over 50 industries. That's what I bring to the table in having this conversation. So when we talk about brand and marketing, what I tell my business owners is that I'd love to promote SBDC on my website and the great work that you do. My employees log on and they learn so much from you on a daily basis, on a weekly basis. That's part of their professional development and their growth. So we ask that they at least complete, one a month as as part of their learning process in the different areas. for those employees that want to grow and move from department to department and stay with our company. So that would be a pitch for me to do to SBDC.
Perfect. And you're welcome to pitch us anytime. That was perfect. Man.
Well,
Uh,
we can talk about that offline because I'm like, okay, you if you're in that area, we can talk about, I can make some introductions and then just start getting those folks on there because the biggest thing I think for our business owners is that once they've gone through that education process, they want more. They want more.
of course.
And
Yeah.
so this, and as I said, I think between SBDC and SCORE, you guys have kicked up your game, and it's recorded, it's easy. And I think the biggest thing for me is that you've addressed the learner issue. So whether I'm watching you, listening to you, or I can download the transcript and read it,
Mhm.
you've addressed the different learners. So that to me, that was a really big aha that supports the business owners.
And thank you. We appreciate it. And we appreciate professionals such as yourself coming on board to share that knowledge and experience with all the people that do attend these webinars. Speaking of, going back real quick, if I can, while we're in Q&A, we have a question going back to some of the negotiations of floors and ceilings. What makes a borrower eligible to negotiate those? Do you know floors and ceilings as far as what makes a borrower eligible to negotiate that?
That would be a Rebecca question. As she said, very few and very sophisticated business owners. I think it would be knowing, I think more than anything is if you know what those floors and ceilings are, and you know what your numbers are, and you're able to go in and have that conversation. Um, I, I think being able to ask that number, and if I was to come in and say, this is the number that I'm looking for, whatever
Mhm.
pushback you give me, whatever response you give me to that is probably would tell me what direction I would need to go. Because
Okay.
whatever numbers whatever work I did beforehand and looking for those floor and ceiling numbers and coming in and borrowing this, that I would be looking at, if it was a range between 1 and 5, then I know what that range is. So if I'm coming in and looking for, and I said, okay, here's what I want. I want a 2, and you come back and said, no, the closest we can get is a 4. So now I've opened up my zone of possible agreement between 2 and 4. So
Right.
in my conversation and asking the questions would get me to where I need to find out what would it take me to get that 3.
Great. And thank you. So we walk in with that information already done on paper for yourself so that you sort of know what you want to talk about. Is that what I hear?
Absolutely. And it's that I'm going to learn as much about this conversation and when Rebecca talked about anchoring, if I'm coming in and I've got my hands raised, most businesses, no matter or whatever you're buying and selling, uh, if I want to sell a building for 100,000, you know, that's what I'm asking for. And I've
Mhm.
got somebody over here that only wants to pay 75,000, but they can go up to 100,000. I want to sell it for 100,000, but I can go down to 75,000. But nobody's letting those numbers know until they get in. And so when you start that far out, you start your anchoring process of, here's my starting number. And some folks will be outrageous, like, I want $200,000 for the house. Well, that's a little outrageous because that's not the market price. That's not the standard. So last week when I talked about negotiations, you need to know what your standards are when you go in. So that's part of knowing what your floors and ceilings, you have an understanding. But now you
Mhm.
get to the zone of possible agreement. And that's where you're going to go back and forth. And you want to focus on outcome, and your behavior and your communication is so important at this time. So it's not one of these take it or leave it, or you're doing this because you're like, whoa. So communication on your behaviors, I'm open, let's talk about this. So tell me what I need to do to get there. And then I have 3 or 4 things that I can talk about. So
Great. No, thank you. Good information. And thank you for the question, by the way, Paula. The last thing I'd like to leave you with before we talk about future upcoming webinars and things as we're about to close is the supply chain. I know that Rebecca was talking about it, but I'd love to hear your input on the supply chain and what can somebody do when things are happening like they are right now, where it just stops. Is there anything you could do preliminarily to kind of
I
put
can
that in your
share,
negotiation top?
you know, I uh, I can share what we have done within the group,
Okay.
within the Goldman Sachs group. When we talk about, and again, this simply goes back to ecosystems. And, you know, if you were to even take all of SBDC's clients and you were to bring them all together in their different industries and who's missing what and what can we make within uh, the next quarter, just even based on each other's support system. Uh, and we did that with the Goldman Sachs group, you know, and that with their own app is that we don't want Brett Augustine to close down because he's missing X, Y, and Z in order to complete those laptops for HP. So the call goes out to within the ecosystems that you have been supporting, that you have been working with, even within your own SBDC group, and said, call out for the following so that we can support. And the way that you would pose this and phrase this, Brett, is if you were the ecosystem within the Dallas area or the North Dallas area, is the growth. It's business owner to business leader, and you are now working collectively to support that community because you don't want anyone in that community to go away. You don't want anybody within your zip codes to go away. So how do I support them with this ecosystem? And so I think if everybody begins to have that communication, but it isn't just about parts, it's about institutional knowledge. Well, even though you don't have that part, we do have some other areas that we're working in that allows you to bypass that. Are you open to a conversation? So now you've got an opportunity for a new business or a new process. So, you know, for us, we've been able to, we can't save everybody, but we've been able to connect people and to have them create their own ecosystems with their own parts and institutional knowledges in order to keep their communities working. You know, and
That's great.
really, you can't save the whole world. So how do I save the zip codes and the businesses within the area that I'm responsible for?
Thank you, Liz. And that's a really great thing that we can tell a lot of the business owners that we service and in trying to connect and work within our own groups here that are being formed, whether it's through your chamber of commerce or whoever it is that you may identify most with when it comes to business. That is really good advice. Keeping it in there and helping each other. Maybe you share parts. I know that Ford and GM have done that before because there's certain parts that are just the same and they're not just parts, but like you said, also the knowledge and experience of their engineers, you know? So that's huge. That's really good and creative. Thank you for that. Are there any closing remarks or anything you'd like to add today, Liz,
You know,
before I move on?
I think why we're still going through this, especially with the supply chain, because it's not something that you and I can fix. I mean, I was at the Port of Houston last week, and okay, short of driving a truck and unloading, can't do it. And you know, I met a lot of truck owners, and the logistics is just a mess. So I think more than anything, it's about being inquisitive. It's about being creative, and you really need to shift that mindset and start thinking from business owner to business leader and looking out. Whereas everybody wanted to keep it hidden in, it's like I don't want anyone to know what I'm doing. I don't want. No, you want to begin to go out there and start looking at who I can partner and network in order to survive, because our inflation prices are going to continue. We're still going to be asking for capital. So how can I change with what I'm doing right now, you know, to take me down to a different path? And that different path may be a better path down the line. It may not seem like it now, but it may further down.
Wow. Thank you. Thank you so much. And we really appreciate that. With that said, I would love to share with everybody some of the upcoming things and thank Liz once again and Rebecca who had to jump off there. But we very much appreciate all of you coming together to bring us your knowledge and wisdom today and experience. Great presentation. Some of the other, by the way, right after this, you're going to get a survey that's going to come to you. Please take 2 minutes to fill it out. Let us know how the presentations are going and what it is that you would be interested in hearing from. We're happy to adapt as we change, and you may find us as well on our website right up here. The QR code will take you there, and you can sign up for upcoming webinars as well as go to our YouTube channel, and it will have some of the past webinars as we present them. So you can go back and catch like part 1, for example, of this particular series, and then come back to this one for part 2. So please feel free to use our website as well for scheduling time with an advisor if you would like to, and as well as registering for these webinars like delivering your presentation, how to perform like a pro by Lorna Kibbe, coming up on the 17th. And on the 18th, Driving Business with Email Marketing by Eric Spellman. Very dynamic speaker there, and he's always got lots of good energy and ideas. Great interaction with all of our speakers, just like today. November 30th, How to Write Eye-Catching Product Descriptions by Ashley Cook. And Ashley Cook's going to follow up with another one on the 7th of December, How to Connect with Your Target Audience. And we all realize that audiences are not just audiences, but the target audience could be a client. So you guys really go there if you can. It's sbdc.nctc.edu for more information, and we're happy to have it. And we are sponsored, and I'd like to bring to your attention just a few people I'd like to thank. Number one, of course, is the Small Business Administration, the state of Texas, North Texas SBDC Regional Office, and North Central Texas College. Thank you all for having this moment here to help us bring these resources to you at no cost. We have many other things coming up in the future. Don't forget to check it out. This ends today's webinar. We thank you all for joining us, and thank you again, Liz, and thank you very much, Rebecca, as well, for joining us today. You guys have an amazing week. It's only Monday. We have plenty more to go.
All right, thank you.